Financial reporting standards are vital in ensuring that companies provide accurate, transparent, and consistent financial information. Different regions and countries have their own set of financial reporting frameworks, such as Generally Accepted Accounting Principles, GAAP, International Financial Reporting Standards, IFRS, and other national standards. The differences between these frameworks can lead to significant variances in how financial statements are prepared and presented. In this video, we will explore the top 10 differences between various global financial reporting standards, highlighting key distinctions that have implications for businesses, accountants, investors, and regulators worldwide. 1. Principles-based versus rules-based approach. One of the fundamental differences between global financial reporting standards is the underlying approach to accounting. IFRS is considered principles-based, focusing on broad accounting concepts and allowing for flexibility in application. On the other hand, US GAAP is more rules-based, providing specific and detailed guidance on how financial transactions should be reported. This difference can affect the interpretation and application of accounting rules, with IFRS allowing for more judgment, while US GAAP often has stricter, prescriptive rules. 2. Revenue recognition timing. Revenue recognition is a critical area where global standards diverge. IFRS generally uses a principles-based approach that focuses on the transfer of control to the customer, which may result in revenue being recognized earlier or later compared to US GAAP. Under US GAAP, revenue recognition is more structured, with specific criteria for recognizing revenue when it is earned and realizable. These timing differences can have implications for companies' reported revenues and earnings, especially in industries like construction and software. 3. Inventory valuation methods. The treatment of inventory is another key area where IFRS and US GAAP differ. US GAAP allows the use of the last in, first out, LIFO, method for inventory valuation, which can help companies lower taxable income during times of inflation. In contrast, IFRS prohibits the use of LIFO and only permits first in, first out, FIFO, or the weighted average cost method. This restriction affects the way inventory costs are calculated and can lead to differences in reported profits and tax liabilities. 4. Leases accounting. The accounting for leases underwent significant changes under both US GAAP and IFRS following the issuance of new standards. However, there are still differences between how the two standards treat lease liabilities and assets. Under US GAAP, leases are classified as either operating leases or capital leases, and each type has different accounting treatments. IFRS, on the other hand, uses a single lease model that requires lessees to recognize almost all leases on the balance sheet, regardless of whether they are operating or finance leases. While both frameworks have moved toward greater lease transparency, the classification and presentation of leases may still vary. 5. Financial instruments. There are significant differences in the way financial instruments are classified and measured under IFRS and US GAAP. For instance, IFRS uses a more principles-based approach to determining how financial assets and liabilities should be classified, as either amortized cost or fair value, while US GAAP provides more specific guidance on classifications. Additionally, IFRS allows for more flexibility in recognizing impairments of financial assets, whereas US GAAP has stricter rules that may lead to earlier impairment recognition. These differences can result in variations in reported financial results for companies that use different reporting standards. 6. Goodwill impairment testing. Goodwill impairment is another area of distinction between IFRS and US GAAP. Under US GAAP, goodwill is tested for impairment at the reporting unit level by comparing its fair value to its carrying amount. If the carrying amount exceeds the fair value, the goodwill is impaired. IFRS, on the other hand, tests goodwill for impairment at the cash generating unit, CGU, level, which is more aligned with the way the business operates. These differences in the level of testing and how impairment is recognized can lead to varying amounts of goodwill impairment being reported. 7. Deferred taxes. Both IFRS and US GAAP require the recognition of deferred tax assets and liabilities, but there are key differences in their treatment. US GAAP generally uses the liability method for deferred tax accounting and requires companies to adjust deferred tax balances based on changes in tax laws and rates. IFRS, while also using the liability method, provides more flexibility in how tax effects are accounted for, especially in terms of the timing of when taxes are recognized and the discounting of deferred tax liabilities. These differences can result in varied tax expense and deferred tax liability calculations between the two standards. 8. Segment reporting. The treatment of segment reporting differs between IFRS and US GAAP, with implications for how companies disclose their financial performance. Under US GAAP, segment reporting is based on the management approach, which means that companies must report financial information based on how the chief operating decision-maker, CODIM, views the business. IFRS, however, uses a more general approach, requiring segment reporting to be based on the company's internal management structure, but with different guidelines for measuring segment performance and disclosing segment data. This can lead to discrepancies in the way companies report segment performance and how investors interpret segment results. 9. Tax impact of foreign currency translation. The treatment of foreign currency translation differs in the way taxes are accounted for under IFRS and US GAAP. In the case of foreign subsidiaries, US GAAP requires that any foreign currency translation adjustment be included in other comprehensive income, OCI, and tax effects are recognized in the same period as the translation adjustment. IFRS, on the other hand, may allow tax effects related to foreign currency translations to be handled differently depending on the specific circumstances, leading to potential differences in income tax reporting. 10. Contingent liabilities. When it comes to recognizing contingent liabilities, US GAAP and IFRS have different approaches. Under US GAAP, contingent liabilities are recognized when it is probable that a liability has been incurred and the amount can be reasonably estimated. However, IFRS takes a more principles-based approach, requiring recognition of contingent liabilities when it is probable that an outflow of resources will be required to settle the obligation. The differences in these criteria can result in different outcomes when determining the need for liability recognition and disclosure. In conclusion, the differences between global financial reporting standards, including US GAAP and IFRS, have a significant impact on how financial statements are prepared and presented. While both systems aim to provide transparency and reliability in financial reporting, the distinctions in their principles, methods, and classifications can lead to variations in financial reporting outcomes. Companies operating internationally must navigate these differences carefully, especially when preparing consolidated financial statements or reporting in multiple jurisdictions. Understanding these distinctions is crucial for accountants, investors, and stakeholders to make informed decisions and ensure compliance with the relevant financial reporting frameworks.